Investors were watching with bated breath as new Fed Chair Kevin Warsh hosted his first ever meeting. Would he signal rate hikes? Would he ditch the dot plot? Would he finally tell us where he's taking monetary policy? We now have the answers. The Fed held rates today, but that's not actually the news. The news is what's coming next. For the first time all year, the Fed's own projections show 0 rate cuts in 2026. Futures markets are now pricing a 66% chance of at least one rate hike before year end, and Warsh made his position clear without saying much at all. He withheld his own dot plot entry entirely, the first Fed chair in 14 years to do so. Less guidance, less handholding, a more unpredictable Fed, and the market didn't like it. Not shocking. The S&P 500 and NASDAQ sold off immediately. And here's the thing, when the markets panic, it doesn't sell carefully. It sells absolutely everything, including stocks that have absolutely nothing to do with interest rates. And that's where I think the opportunity is right now. I'm going to show you 2 stocks that our system flagged as strong buys. Stocks whose businesses are completely disconnected from whatever the Fed does next, and they just got cheaper along with everything else today. For long-term investors, that's not a reason to panic. That's actually a potential entry point. And make sure to stick around for this second entry pick. It's the one Wall Street is almost completely ignoring right now. Hi, I'm Jacob Wade. I'm a financial coach for high-income earners that want to retire early. And if you like these types of videos from me, consider hitting the like button below. It lets me know you want more market breakdown videos just like this one. And let me quickly break down what actually happened during the meeting, because there are a few layers worth unpacking. So the headline is simple, right? The Fed held rates steady at 3.5 to 3.75% for the 4th straight meeting. That part was actually never really in question, especially based on recent inflation data. The real story here is the dot plot. In March, the Fed's own projections still showed the median year-end rate at around 3.4%, meaning policymakers expected at least one rate cut by December. Today, that last remaining cut projection disappeared entirely. In fact, Warsh confirmed on camera that he was the missing dot, the one projection absent entirely. The new median forecast now shows the federal funds rate ending 2026 at 3.8%, a quarter point above where it sits right now. The base case is no longer a cut. It's actually hold, drifting toward maybe a hike. Now, several policymakers have argued that rate hikes should remain an option if inflation stays above target. And at least 3 voting members are now projecting a hike before year end. And a survey of 34 former Fed officials conducted in early June found that 17 of 32 respondents said a rate increase would likely be appropriate for 2026. And the committee is genuinely divided and honestly leaning toward hawkish. And then there's Warsh himself. He withheld his own dot plot entry completely, the first Fed chair to do that in 14 years. JP Morgan economists wrote that given the inflation backdrop and a firm labor market, the FOMC should remove the easing bias from the statement entirely and replace it with a neutral sentence or no forward guidance at all. And that appears to be exactly what Warsh did. And he went even further, announcing a task force to overhaul major Federal Reserve operations. This isn't just a minor tweak, it's a whole new regime. And he's telling markets, don't expect me to telegraph my next move, figure it out yourselves. So that backdrop makes all of this hit harder. Inflation came in at 4.2% in May. That's a 3-year high. And the economy is still adding jobs. The case for cutting rates was already thin, and today Warsh made it clear that he's not going to pretend otherwise. Goldman Sachs Asset Management said it plainly after the announcement. The Fed's hawkish shift isn't about energy prices. Their base case is that the Fed can still avoid hikes, but they called the path narrow and said there will be a high premium on incoming inflation data. So the bottom line is this: the easy money era is over. The question now is, what do you do with your portfolio in a world where rates aren't coming down and actually might go higher? And by the way, if you like timely market updates like this, then I strongly recommend you attend WallStreetZen's next free live training. They take place every Monday at 7 p.m. and they're hosted by our editor-in-chief, Steve Reitmeister, who gives a state-of-the-market overview and discusses his top stocks of the moment. Go to wallstreetzen.com/live to sign up right now. Now, here's the thing about a moment like this. The obvious plays, right? Banks, defense companies, software with recurring revenue, they're already crowded. And the market reaction today shows you exactly how crowded it is. The S&P and NASDAQ sold off immediately. Treasury yields moved higher, and the Russell 2000 jumped as small caps caught a relief bid on the hold. 3 different markets, 3 different reactions, all in the same minute. That's not really clarity, that's chaos. And chaos is usually a sign that the crowd is just guessing. And it's not just the rate decision spooking people. Warsh's task force announcement made it clear he's restructuring the whole Fed itself. Markets hate uncertainty, and right now, there's plenty of it. So I ran the rate-sensitive sectors through Zen ratings, and the industry grades came back at D and F. Even if the macro thesis is right, the underlying stocks aren't showing the fundamental quality that we would look for. So I'm not chasing. Instead, I looked for A-rated stocks and industries grading out at a B or better, businesses with strong fundamentals that keep compounding regardless of what Warsh does next. Stocks that are steady, durable, stocks that nobody's talking about today because everyone's too busy watching yields tick higher. Now, if you want more timely market updates just like this one, go ahead and hit the subscribe button below and make sure to turn on notifications so you always know exactly when we post videos just like this. So in my research, where did I land? Healthcare. And I want to explain why, because it's not the obvious choice at first glance. Now, healthcare is one of the only major sectors in the market where demand has absolutely nothing to do with interest rates. People don't delay cancer treatment because borrowing costs are high, and premature infants don't wait for the Fed to cut before they need care. That would be ridiculous. No. The revenue these businesses generate is driven by medical need, not by monetary policy. And right now, while everyone is trying to figure out which rate-sensitive sector wins or loses from today's announcement, healthcare is just quietly doing what it always does. So when I screened for the highest rated stocks in the sector, A ratings on Zen ratings, and strong industry grades, there are 2 names that came back, and let's walk through each of them. Now, before I get into this, I do want to remind you, I'm sharing real stocks and data, but I'm not sharing personalized investment advice. Investing is risky, and you are responsible for your own investing decisions, so always do your own due diligence. All right, first up is Neurocrine Biosciences, ticker symbol NBIX. They're a pharmaceutical company focused on neurological and endocrine disorders, treatments for conditions like Parkinson's disease and congenital adrenal hyperplasia. People don't stop taking their medication because the Fed is hawkish, and that's exactly the kind of demand durability you would want right now. Now, the earnings numbers explain why this is so highly rated. Neurocrine grew earnings 121% last year, and over the last 3 years, earnings have compounded at 208% annually. Revenue is at $3.1 billion with a 21.6% profit margin. This is a profitable, scaling pharmaceutical business, not a speculative bet. Now, what does Wall Street think of this business? Well, 18 analysts cover Neurocrine, 9 have it as a strong buy, 7 have it at a buy, and just 2 are at a hold and not a single sell recommendation. The consensus is strong buy. Now, the most bullish price target here represents more than a 50% increase from current levels, and that comes from Yigal Nochomovitz of Citigroup, who is a top 9% ranked analyst in the WallStreetZen database based on stock picking track record. And our own quant rating system agrees. Neurocrine comes in with a Zen rating of an A strong buy recommendation. Each Zen rating is built on 7 different component grades that let you see a stock's strengths and weaknesses. And the 2 standout grades here are the value and financials, both at an A. This suggests the business is attractively priced relative to what it's actually worth, and the balance sheet actually backs that up. Now, the one risk I want to flag here is the stock price has been trending down recently. So if you're looking for something that's already running hot, this isn't it. But if you're looking for a fundamentally excellent business at a reasonable valuation that Wall Street is actually broadly bullish on, Neurocrine fits that description. All right, now stock number 2 is INFU System Holdings, ticker symbol INFU. This one isn't a household name, but they do important stuff. INFU Systems provides infusion therapy services. They manage ambulatory infusion pumps for patients receiving treatments like chemotherapy outside of a hospital setting. They're the logistics and services layer connecting the hospital to the patient at home. As healthcare shifts toward outpatient and home-based care, INFU Systems sits right in the middle of that structural trend. And like Neurocrine, cancer patients don't pause chemotherapy because of a Fed decision. And the earnings story backs that up. INFU Systems grew earnings 171% last year alone, well above both the industry average of around 5% and the broader market's 85%. And that growth is actually accelerating. The 171% figure is running above the company's own 5-year compound rate. The business has turned a corner and is building momentum fast. Now, on the analyst side, coverage is thin, but it is very bullish and from a highly rated analyst. The one analyst tracking INFU on WallStreetZen is Kyle Bowser at Roth Capital, who's a top 1% analyst based on historical stock picking track record. Their price target suggests over 70% upside potential from where it's trading today. Now, you shouldn't make investment decisions based on what one analyst says, but the track record and the high target are worth noting. And this could change, so add INFU to your watch list on WallStreetZen so you can get updates as more coverage develops. Now, the Zen ratings also support this bullish thesis. INFU System comes in with an A strong buy, and it's the #1 ranked stock in the medical industry out of 42 different companies. The standout component grades are sentiment and financials, both at an A. Sentiment tells us that smart money is paying attention, and financials tells us that the underlying business is actually genuinely healthy. Now, one consideration here is growth and momentum are both at a grade C, which is not worrisome, but not necessarily great. This suggests that the market hasn't fully caught up to what the fundamentals are actually showing for this business. Now, that's a comment set up for stocks that are early in a recovery, but it does mean patience may be required. If you want something that's already moving, INFU Systems isn't there yet, but if you're willing to get in before the crowd notices, the data makes a strong case. Now, if you like timely stock picks like this, let me remind you that you can get them in abundance every single Monday at 7 p.m. Eastern Time when our editor-in-chief hosts his weekly live training. You won't just learn what he's buying, but why, enabling you to find more great stocks using a similar framework. Plus, he does reveal his weekly trade of the week, which is his highest conviction pick of the moment. So again, you can sign up at wallstreetzen.com/live or use the QR code on the screen right now. Just take a picture of it, click the link, and sign up for free. Again, we'll leave the link in the description, and we will see you there. Okay, so let's recap. The Fed isn't cutting rates. Warsh isn't telegraphing anything, and the era of cheap money and easy forward guidance is honestly over. And a lot of investors are going to spend the rest of 2026 chasing the wrong trades, trying to figure out what it all means. The better move here, in my view, is to stop trying to outguess the Fed and start owning businesses that don't need its help and don't depend on rate cuts to perform. Now, the best opportunities right now aren't in the sectors everyone's scrambling into today. They're in the steady, fundamentally strong businesses that are quietly compounding while everyone else watches the dot plot. That's where I would be looking. So there you have it. Now, are you with me in that the best approach is to tune out the noise and look for quality, or are you taking a different approach? I genuinely want to hear what you have to say. Just drop a comment below. I read every single one. And if you want another timely video about an important market-moving event, check out our video about the Iran peace deal and how it can impact your portfolio moving forward. You can see all the details in this video right here.